again, in some respects, that was the formative part of how we set up our business. And a lot of the early days there where we had the poor office, as you describe, we used to have founders of amazing technology companies come into this like pretty terrible room with, as you say, chairs. Literally, there was a meeting I remember where a founder literally fell off the chair, like literally the leg collapsed. But that's all part of the journey, right? And in some respects, I hope founders saw us as a firm of substance, because we certainly weren't selling them on the quality of the office. So hopefully it was the quality of the talk or the advice or the discussion that made up for the issues around the office environment.
Hi everyone, I'm your host Rohit Bhargava, and you are listening to episode 167 of the Startup Playbook podcast, a weekly series where I sit down with successful tech founders, investors, and operators to unpack their journey, lessons, and insights to help current and future entrepreneurs. The voice that you heard a little bit earlier was that of Justin Lipman, partner at EVP, and our guest for this episode. EVP is a venture capital fund that is focused on investing into B2B software and marketplace companies. Over the last 7 years, the firm has grown from its first fund of $25 million to now managing over $250 million in funds under management, with an incredible portfolio with the likes of Deputy, Shippit, Ignition, and Siteminder, just to name a few. In this episode, we covered a wide range of topics, including why EVP decided to take a niche approach to their investment strategy, the metrics and benchmarks that Justin looks for when assessing investment opportunities, and Justin's views on whether the power law holds the same power as it did a few years ago. As you'll hear throughout this episode, Justin places a large amount of importance in founders being across the data and numbers in their business, and that's why I'm excited to partner with Sender. I run all of my personal and business accounting needs through them and can say from first-hand experience how great it is to have a dedicated team to help support me in this area. They're more than just an accounting firm and have a dedicated focus on founders, funders, and startups, and can help you with everything from managing your tax to balancing your books and even helping with your exit strategy. To find out more, head over to sender.com. And whether you're taking on external capital from great partners like EVP or bootstrapping your way to success, you'll want to make sure that you have the right legal infrastructure in place. LawPart's legal advice plan gives you access to lawyers on demand for one low monthly fee. You can create documents, sign online, and even have a lawyer on call to help with any legal issues at a fraction of the cost. They've helped save Australian businesses over $100 million in legal fees and are offering Startup Playbook listeners up to 20% off their most popular legal plans. To get access to this exclusive discount, head over to lawpath.com/playbook. And finally, if you're an early stage founder looking for the right technical partners for your business, you'll want to speak to the team at Dovetail Studios. On top of being a renowned product development partner for startups like Afterpay, they also operate a venture capital fund that invests in early stage businesses that go through their venture studio program. So if you're an early stage non-technical founder looking for a talented team to help supercharge your success, head over to dovetailstudios.com. With that out of the way, and without further ado, here is my interview with Justin Lipman. Hi, Justin. Welcome to the Startup Playbook podcast, and thanks so much for taking the time to be on the show today.
Hey, Ro, thanks for having me, and great to be here.
For those people that maybe aren't as familiar with your background, do you want to share a little bit about your story and what got you here today?
What got me here today, to be honest, was a fair bit of luck and good fortune over the journey. I've been sort of with EVP for 7 years now, and the business really started out of an angel investing track record for a very long period of time, and is now sort of transitioned into a more traditional venture capital firm based out of Sydney, Australia. My background is in sort of various finance jobs before this, in big corporates, which was, fairly boring, but gives you a great way to start your career. And I was sort of at a point in my sort of personal journey where I was looking for something quite different, always interested in the sort of technology space, and feel very fortunate to have met two partners of mine, Howard Liebman and Led Zeckley, a fair while ago now. Sort of jumped ship with them early doors to try to build EVP into a sort of funds management business. We spent, the first year without an office as an advisory business in startup land in Sydney, Australia. It took us a year to raise our first fund, which was a small $25 million fund. And it's been a really fun journey over the last 6-7 years to sort of, build EVP. We're a small funds manager, but build EVP into a, specialist B2B software investor with 43 odd portfolio companies and more than 250 million under management now across 4 funds. And, most importantly, I've just been really lucky to work with a bunch of, amazing startups, to be honest, and startups that have grown into sort of genuine technology companies today. So yeah, just feel really fortunate to sort of falling into the career path I have, and sort of very privileged to work with, our team of 13 at EVP today, which is great.
In the last interview, I spoke to Dan Krasnostein from Squarepeg, who kind of very similar to you mentioned that he sort of very accidentally fell into the world of VC 10 years ago. And obviously the landscape back then was very different to what it's like now. And I believe you joining EVP sort of started from having a conversation over 6 beers. Is that right?
Geez, you've done some research. I mean, that story's got out over the journey, but yeah, it was a fun story. I was at Credit Suisse in a suit and a tie. It was certainly a public holiday. I'm pretty sure it might have been Australia Day. I met sort of Howard. Howard had listed a medical device business in the US. He was involved in a sort of corporate journey over there and had come back to Australia for family reasons. We were put in touch by a guy called Daniel Brand. He's the founder of a business called SnapRevise. It's still a technology business now based in London in the UK. We sort of got put in touch to have just a chat about things generally. Howard was thinking about sort of building out his business in the Australian startup community. And I was sort of at the point where the division I was in at Credit Suisse, which was the emerging companies technology division, had actually been bought out. And we were offered jobs in sort of the big Credit Suisse investment banking team. And I was at the point where spending a year doing something quite different, hopefully get a great learning experience. It was sort of where I was at emotionally. And yeah, you're right. Down in Circular Quay, I think we had a lot of beers. We sort of got on famously. We often joke, I don't think I've had a beer with Howard since. We have a whiskey on a Friday night, but certainly nothing like that. Sort of walked away from that conversation feeling clearly a great person to sort of build a relationship with as a bit of a mentor personally, and clearly had sort of a big vision of what he set out to do. So good story and part of the folklore of EVP, I suppose.
Off the back of that, was it a difficult journey then to make the transition and switch into VC? Or going back to that time 7 years ago, what was that decision-making process like for you to kind of join EVP at those early stages?
Yeah, it is a big change. You lose all the amenity of the big corporate office, the nice showers, all of that stuff. You lose the big team, you lose working with massive ASX 200 companies doing quite honestly really interesting strategic work. And you flip to a 5-10 person business in a shared office or no office. Quite frankly, there's no interesting strategic work at that stage of company. It's just execution mode and getting it done. But it's a different kind of excitement and a different type of learning. And it definitely was a transition. I mean, Howard and I worked in a very small shared working space with a small consulting business and a charity technology company for many years there. And again, doing advisory work in the space. So it certainly was a very large transition. But, we often talk about, while a lot has changed in terms of, we're not a big business, but in terms of the scale of our efforts, and probably most importantly, in terms of the types of companies we're fortunate to have invested in some respects, not a lot has changed over the journey, in that the consistency the whole way through has been like an inherent curiosity around the work, a drive to genuinely help these businesses scale. And, what struck me working with Howard and Les early days, I think they try to imbue it in the whole team even today, is that sort of inherent curiosity and passion for the work has remained the whole way. And it sort of doesn't matter if you're in a small shared workspace with no brand and no fund, you can still have that sort of same passion for the job the whole way through. So yeah, certainly a lot's changed. It was an interesting transition, sort of buying your own laptop on the first day and different environment, but it's been amazing. And I feel very fortunate to sort of be given a lot of experience as sort of a young VC investor early on, and been very fortunate to go on the journey with some companies that, as you do that, it just informs your pattern matching, your experience, and that's sort of gone from there.
Yeah, you just mentioned some of the early days of EVP. I spoke to Dan, who's one of your colleagues and partners at EVP as well. He was telling me a story about how I think your first office had one meeting room where all of the chairs were broken and the AC didn't work, which is obviously a far cry from a startup's perspective, what they think that VC funds operate like. And as you mentioned, you spent the first year sort of advising companies to essentially help pay salaries, to my understanding as well.
Yeah.
Do you want to sort of go back to the kind of the early days and kind of talk about the journey of what it was like raising the first fund and I guess the early days of EVP?
Yeah, for sure. Like Dan's right. I mean, it's full transparency. It's public. The VC funds make 2% management fee of their funds under management. And, you can do the maths, 2% of a $25 million fund. And it took us a year to raise that amount of money. It doesn't cover much, right? And it certainly doesn't pay market salaries or anything like it. And, I think a lot of people have sort of come to realize this, but the VC fund or any fund management business for a long period of time really is similar to starting any type of business, in that there's great uncertainty, there's difficult scaling journeys, there's a whole bunch of referenceability you have to build. And, I think we were fortunate with some of the angel investment track record historically, investing in companies like Siteminder, Hotel Club, Shippit, Deputy, early days, which have been outside success stories in and of themselves. That sort of established a level of credibility and track record, almost like a right to play in the community. And I think that's a pretty common pathway for a VC manager. But yeah, certainly the early days was a very scrappy, startup, to be honest. And, feel in some respects that we've trodden a similar path to a lot of founders and early stage employees as they build their own business, where you simply just don't have the resource, the capability, the ability to scale that the big corporate with great funding does. So a really similar journey, but again, in some respects, that was the formative part of how we set up our business. And a lot of the early days there, where we had the poor office, as you describe, we used to have founders of amazing technology companies come into this like pretty terrible room with, as you say, chairs that literally, there was a meeting I remember where a founder literally fell off the chair, like literally the leg collapsed. But that's all part of the journey, right? And in some respects, I hope founders saw us as a firm of substance, because we certainly weren't selling them on the quality of the office. So hopefully it was the quality of the talk or the advice or the discussion that made up for the issues around the office environment. But yeah, we're still a small business, but fortunate to sort of have built the business to a position now where we can attract amazing talent and sort of, have enough history now of deploying 4 funds across the Australian market that we're sort of somewhat growing into the next phase of our journey, I suppose.
Yeah, and you touched on this a little bit earlier, but what are some of the things that have stayed the same or changed as you've gone from $25 million from the first fund to, I believe it's $250 million you've got in funds under management now?
Yeah, so definitely the passion for the work. I spoke for this before. It's very similar. Les is a shining light in that respect. He's working 7 days a week out of passion and interest and enjoyment in the job for no other reason. And, the big cultural value internally at EVP is that it really is more than a job for us. The way we build our funds, which is maybe a bit different to others, is we don't have any institutional LPs. We don't have super fund money. We have some hundreds of high net worth family office investors that, quite frankly, are personal relationships. All of our friends, all of our family are invested in the funds, and obviously all of our own dollars. And I suppose the way that we sort of manage the business, not to say that others don't do it with super fund money, but at least the way we manage our business is one of, all in, more than a job, complete care for all aspects of the business. And that's definitely an important value internally and something that's remained very true. The other thing is just the personal relationships. Like Dan, who you mentioned before, one of the partners at EVP with me, I think we've spoken to each other every single day for 7 years. And, he'll call me at 11 p.m. on a Sunday night to discuss a business strategy, most weeks on a portfolio company that's going through something. And again, it's that type of, closeness bond internally that I suppose you build by virtue of sort of going through a journey together. But it's also something that, it's very important to all of us that we show up to work working with, excellent people, like-minded people, all striving together and very committed. I'd say the other thing, on a more technical level that's remained very true has been the actual investment strategy. So we might unpack this later in our chat, but we've been very consistent in the type of investing we've made over a very long period of time. So, it's always been about early stage business to business software investing. And I think especially recently, we've leaned into that specialization a lot more in the last couple of years, where exclusively we're looking for that type of business model across any sector in any industry. But with that specialization, which has been true the whole time, it's much easier to do our job to its full potential, in the sense that it's easier to help businesses post-investment because they're all tackling similar issues on their scaling journey. It's much easier to diligence and analyze companies on the way in, because you get pattern recognition, you start to understand the drivers and what matters. And it's also something for our investor base that they really appreciate, because we position that this is our swing zone, this is our area of competence, and we stick very closely to it. And I think they appreciate that. And I think, most importantly, the other stakeholder in our business is clearly the founders that we work for and those partnerships. And I think they appreciate it, where, if you're an early stage software founder in the Australian community, I think you have an understanding of, why EVP might be an interesting partner for you. And if you're building, a medical devices business, a biotechnology company, a space tech business, you probably have a good understanding of why EVP can't help you on your journey. And we really try to be true to ourselves of only partnering with people we can actually help. And the whole way through has the sort of almost hurdle to overcome there internally is, can we help this business? And is it of the business model where we think we have an expertise, and everything else we just, there might be great businesses, but we can't live up to that promise of the founders. So, in terms of the consistency all the way through, it's always been around early stage B2B software investing.
One of the other people that I spoke to as part of the research process for this interview was Will from Shippit, who's one of your portfolio companies. And one of the things that he mentioned was how, especially through this period, how kind of speaking to you and EVP has helped them focus from, trying to do 5 different things to just focusing on one. And it's really interesting as well, kind of hearing your sort of perspective approach of really kind of doubling down in one area versus, I guess, from the outside looking in from a lot of other funds as they sort of continue to increase their funds under management, there's generally a sort of broader mandate. Was that a difficult trade-off for you to make, or has that kind of always been sort of clear in terms of your investment strategy from day one?
Yeah, okay, so it's a really good question. And I agree, a lot of our peers have raised very large funds, and not just in Australia, but globally. The proposition, particularly during the last couple of years of just exuberance, has been we invest seed to pre-IPO, we do all stages, we do all business models in all sectors, and the proposition is that we are generalist, we have deep pockets, where we might be active or passive, but we're good, we're trustworthy, and we have an experience set generally. And what we try to do is sort of augment that pitch, say all of that stuff, but add on a layer that all we do is this specialization. And I obviously touched on the business model before, but the other one is certainly one of stage. So, Will from Shippit is a good example of that. So Shippit is a logistics technology business helping physical and online retailers to sort of more efficiently ship their parcels domestically. I met Will 6-7 years ago when him and Rob were still in their day jobs thinking about it as an idea, and have been lucky to work with them now for a long period of time and remain very involved. But, I think for a business like that, they've had an incredible funding journey, raising hundreds of millions of dollars globally from all kinds of investors. But interestingly, there's a clear demarcation on that type of register, as an example, between what role which fund can play. And our role has been very clear with a business like that, where we think we have an understanding of how to scale a company, for example, from 10 people to 200 people. We understand things like org design, particularly in the B2B environment. We understand how to build your sales team, your commission structures, your pricing strategies, all of that sort of scaling journey. And then we've been fortunate to be on the journey to some companies that have been to 1,000 staff plus. But truthfully, that's not really where we have a right to play. There are much better funds, much more sophisticated with better resourcing, that specialize in late stage investing, that know the playbook from going to 500 to 1,000 people, and they've done that 30 times in their career. So I think, again, it just comes back to sort of living up and being true partners to the founders we work with, of giving them an understanding of where can we help you, how can we help, and to date it's all been around stage of development and also business model. And I must admit, like, even from a personal point of view, when you unshackle some of that burden and you get clarity on where you assist and where you don't, it really helps the relationship. Like, Will and I are now great mates. He understands exactly what he can call me and ask me about, and he knows exactly the areas I won't be able to assist him. And equally, as a successful investment from EVP and, a fantastic, one of Australia's best technology companies, he kind of goes on a journey now with a new group of investors. We remain on the board and sort of been involved, still today. But you garner different expertise at different parts of the journey. As a young VC, I'm not really sure how you could live up to being a great seed investor, a great pre-IPO investor, a great late-stage investor across all business models and all sectors. I think you kind of only are able to truly be value add if you specialize. That's at least our house view, I suppose.
Yeah, and I guess from a portfolio construction perspective as well, I know that you have a sort of slightly different approach to most funds. Do you want to share how you sort of think about portfolio construction at EVP?
Yeah, sure. So bear with me because, I hope this is interesting, but, we can get as technical as we need to in this talk track, I suppose. But most people do comment that the way we've built our portfolios is a little bit different to the conventional wisdom. So firstly, they're much more concentrated. So we have an active investment mandate where we take board seats with all investments, And they're all sort of concentrated 10 or so portfolio companies in each fund. And to give you an example, in our first fund, we allocated 20% of the funds to a business called Resdi in 2 years of the investment period, which is highly unusual. And the conventional wisdom in venture is that returns are governed by a phenomenon called, the power law of returns or power law distribution. And basically what it says is that if you're building a venture fund, your fund level returns will be massively skewed to one or two enormous outcomes, and then the long tail of the rest of your portfolio, if they're zeros or if they go okay, the returns generated from the rest of the portfolio won't be material at a fund level. So to sort of talk that through, if you have a $100 million fund and you allocate it across 10 businesses, roughly equally, the theory goes that your top performer, you invest in Facebook or Google or some incredible business, that investment in of itself might generate $500 million of value, and that investment in of itself over time would generate 5 times cash on cash returns at a fund level where you've got a $100 million fund in of itself. And what happens to the rest of the investments is, even if they go quite nicely, they're going to be immaterial in the context of what that single investment returned. And if that's the belief, and there's some data that supports that in the US that has played true for a long period of time, but if that's the belief, the rational behavior is to go after opportunities with asymmetric upside, enormous outcomes, home runs, swing for the fences type behavior across all investments. And a big mental model for a lot of VCs is that each investment they make needs to be able to return a multiple of the fund in of itself. And it leads you to position your fund towards, one, lots of small bets in the market all over the place because it's all about optionality. 2, companies with enormous market opportunities that could scale really quickly. And 3, less focus on downside risk protection, because at the end of the day, as long as 1 or 2 of these things hit it out the park, the fund will be okay. So with that long introduction, the approach at EVP has been very different. And our promise to founders is we've never had a business go to zero. I think we've had 1 down round over literally 3,000 transactions in the last 7 years. And the promise to founders is we will do everything. We will be 100% committed to make this work, and we'll be on your journey, active participant. And importantly, we're not looking to gamble on your career or your business in the hope that it goes really well. And quite frankly, if it doesn't go well, it doesn't really affect us, even though it affects you, acutely and affects your career. And that's been a really important positioning. That's just, almost emotionally how we like to work with people. And it just hasn't been our experience that we have 1 or 2 outlier returns. We've been lucky to be on a journey like Siteminder where you can generate 100 times outcomes and businesses can scale very aggressively, but we've had a far more normal distribution of returns. And I think it's because of the business model. It's not because of any expertise on our behalf. It's just the stage of investment, the resilience of the B2B software model, a lot of downside protection built into those businesses. I just wanted to touch on one thing. So I think that's maybe interesting to the listeners, but the more technical analysis is the other really interesting trend that's happened over a long period of time now is that the risk profile of these businesses has fundamentally capitulated. If you cast your mind back 20, 30 years, the view of investing in any technology, even a software business, was that it was extremely high risk proposition. It wasn't even a legitimate asset class. Like VC wasn't a thing. And if you look at what's happened in the last 3 to 5 years or last decade, is that the risk profile or the perceived risk profile of these early stage companies has collapsed. There's been an absolute flood of supply of capital from all these new sources into the market. So you have public equity investors, hedge funds, institutional investors, direct family offices, all pouring cash into the early stage VC space, largely because the perceived risk has collapsed. And in a simple, economic analysis, just fundamentals 101, where the risk profile changes, you get more supply of capital, and then you drive up your pricing. And everyone knows that the average seed round 10 years ago in Australia was probably a $500,000 check at a $2 million valuation. And the average seed round today is probably literally 10 times as much. It's probably a $5 million check at a $20 million valuation. So where you have your entry price change so dramatically because of the supply of capital, the change of the risk profile, the returns you're able to generate from those types of investments have just fundamentally diminished by a factor of 10. And notwithstanding that you can still generate outsized returns in VC, and for what it's worth, we target 5 times cash on cash for our investors, and all the funds are well on track to achieve that. And you can still have great winners. The point of this statement is that if the upside and the absolute outlier cases and the returns able to be generated from VC investing has decreased, as the risk profile has decreased and the competition has grown, then the impact of that power law phenomenon where we started this chat, the impact of that has decreased. And if your view is on portfolio construction, you should swing for the fences, hope that one is an absolute home run, don't worry about the rest. If the absolute home run has reduced in size by a factor of 10 or very materially, then the whole asset class and the whole way you construct a portfolio, in our view, is becoming more akin to a traditional private equity portfolio, maybe even a property portfolio, an equities portfolio, where it's a lot less about swinging for the fences for these asymmetric upside, and it's a lot more about just consistent returns across a portfolio of excellent businesses, which in aggregate together will drive fund level outcomes. So I think, not only do we enjoy the emotional partnership approach of working with founders to make it happen, and that's a big thing for us, there's also some sort of sound technical reasons why I think the impact of that power law sort of conventional wisdom has sort of just decreased over the last few years. So again, a long monologue. I hope that was interesting, but that's sort of how we think about it at EVP.
One of the other bits of feedback that I received as part of the research process was, one of your superpowers from, according to Matt DeBoer from Athletic Ventures, so big shout out to him, was how you sort of dig in a little bit deeper into decks than most, and how you sort of really have a more sort of rigorous approach and kind of the way that you approach due diligence and the constraints that you put around the types of companies that are the right fit for EVP. Do you mind sharing, for the benefit of founders that are listening to this, what does that specifically look like? And, what are components in decks or particular things that really stand out to you when assessing companies for the first time?
When you're investing in an early stage technology company, you simply can't rely on the traditional financial analysis of a later stage investor, self-evidently, obviously. So you have to come up with different patterns, different metrics, different ways of analyzing something to basically increase your confidence level that a product or a service being built by a team is hugely valuable in the world of their customer. And basically what we do in diligence is, yes, we spend a lot of time thinking about the upside. Yes, we need to see a big market opportunity and the ability to build a big business. But we spend a lot of time thinking about risk mitigation on the downside. And a lot of that is focused around this concept of, mission criticality. And as a B2B software investor, I think most fundamentally, we are trying to create a good understanding of how important is this product or service in the minds or the day-to-day of their customer, and how reliant are they on this product or service to go about doing their business or go about serving their customers or some part of their workflow. And the way that you can do that in early stage companies, notwithstanding you have very skinny data set in terms of revenue, financial, traditional, measures, you might actually have a very rich data set in terms of engagement or usage or other measures that are actually really strong indicators of how mission critical this piece of software is in the world of their customer. So, to give you an example, we invest in a business called Henry. It's a Wellington-based business. Henry helps independent earners, so think freelancers, those types of people, with a financial tax and admin solution. And basically the idea is it almost replicates the PAYG experience in Australia of a salaried employee for the independent earner, drives great benefit in efficiency, etc. When we first invested in that business, I think they had about 600 or 700 users across Australia and New Zealand, monetizing at a very small way. It was a very small business. Revenue would have been, less than $20,000 a month. But because there were some hundreds of people interacting with the product, you could actually ask the team for how often do people log into the service? How long do they stick using the app? What does the retention from an engagement and usage point of view look like over sort of a longitudinal basis? And you can basically build almost like a cohort analysis, not on revenue or profits, but on usage. And that gives a very clear indication that people log into this thing all the time. They're totally reliant. They'd never churn. And then obviously you can just pick up the phone and speak to dozens of them and get that as well. So, in terms of the analysis, we are very data-led and metrics-led despite being a very early-stage investor. It's really important for us to understand trends, patterns in data to sort of inform the future of the business. We actually won't invest in a business if we can't observe the data to support the proposition. And that's frustrating. Interestingly, we often say this, if you're an enterprise SaaS business selling multi-million-dollar contracts, you might have 3 customers, you might be generating 10 million of annual recurring revenue, which is a very substantial business with 100 staff, say, but the data set is just not dense enough to inform a position that, there's repeatability in the sales motion, there's reliability in the churn profile, and there's strong engagement and mission criticality in how people use the product. Versus the Henry proposition I referred to earlier, despite them being extremely early in terms of revenue trajectory, they had such a density of a data set that you can actually draw great inferences, trends, patterns to inform the investment. So yeah, we do spend a lot of time thinking about data. We've done a lot, build a lot of stuff internally to help with that. And that's sort of the process on the way into an investment.
Yeah, and just to dig into that a little bit deeper, when you kind of talk about the very sort of skinny data set that you have to play with on that, when you're doing an analysis or kind of going through the due diligence of these companies, are you comparing them to baseline metrics for portfolio companies that you've already invested in, or is that kind of more based on specific metrics that you think of that particular market for that company?
Okay, great question. So yes, there certainly are patterns and benchmarks that we look for, 100%. They are individual to a company. They are explainable. There could be variances that make sense. But definitely, again, the focus on the investment model allows us to have a much, I suppose, clearer picture of what good looks like on the way into these investments. We're not Robinson Crusoe. These metrics are publicly available and sort of, I think most funds would think about this type of stuff. But you definitely, when you invest in a B2B SaaS company across tour and activity operators, across marketing, across education, across trades and services at similar stages, they have similar metrics. And once you go on the journey with a company like, Deputy that's scaled very quickly over a long period of time, you start to understand the inputs to their scaling journey, and that starts to inform how you think about new investments. So yeah, it's definitely one of benchmarking and metrics, and definitely that informs the whole process. There's certainly pattern recognition and bias that comes into it. I think bias is sort of a dirty word in investment decision making in some degree, and that's, I agree, and that's understood. But I suppose where you're trying to specialize, there is certainly some positives that come out of biases, particularly in relation to metrics, that informs the decision. So I think we do have a good understanding of what that journey towards mission criticality really looks like, and we also have a bit of an understanding of what the early signs of repeatability in the scaling journey starts to look like, even at an early stage.
Yeah, and something that Will mentioned is that a lot of the feedback that he gets when speaking to investors is how great their data set is and, how across their numbers they are. And they said that a large part of that is through working with you on that specifically. And, I know that, from speaking to a lot of founders, especially at the very early stages, a lot of the founders aren't necessarily across the kind of key numbers of their business or don't really know what are the specific metrics that they should be tracking, especially in the first conversations to investors. So I guess with that B2B SaaS focus, do you have any sort of key metrics that you think that are sort of absolute things that are maybe sort of out of the ordinary that founders often miss in first conversations with you?
Yeah, for sure. I think, interestingly, chatting to a couple of our US VC peers, so some of the guys from A16Z, they often joke that if you can just introduce us to 10 of your customers, and if they can just tell us how much they rely on this service or product, the investment case almost unfurls from those conversations. And that's very true. So I think starting point is for founders is if you build fantastic customer relationships and you build genuinely an interesting product or service and a great business, venture funds will understand that and they'll be excited and the investment case almost writes itself. So a lot of the metrics that I'm about to touch on are almost downstream lagging indicators of great stuff that's been done earlier in the journey in relation to the service or the product. But some of the metrics that are maybe more interesting is, again, all of that engagement piece I was speaking about before. So it's amazing how few businesses pitch to us and have an understanding of how frequently their customer logs in or how many users inside an organization actually interact with the product. And that clarity of piece is something that's really compelling if that's pitched correctly. We're clearly interested in understanding a lot about the scale, the sales journey, the marketing journey, understanding the efficiency of a go-to-market motion. That's pretty common for everyone. So all kinds of metrics around that in terms of sales cycle and CAC and payback period. The one that we spend a bit more time thinking about, which maybe is less common, is win rate on demo to sale in a B2B environment is actually really telling. We're interested in businesses that I suppose have quite a high win rate in the early stages of each conversation, because typically they're founder-led sales, so they have an unfair advantage to sort of win a customer. But more importantly, I suppose the view is it's really hard to build a product that a customer loves. That's a really difficult journey that takes potentially years of experience. It's still difficult, but it's relatively easier to build a go-to-market motion around that sort of core capability. And if you can get conviction that we're delighting customers, we win a lot of them every time we chat to them, the theory goes that it'll be easy to just find more customers that look, feel, smell the same as the existing base. And that win rate is an interesting sort of indicator of how easy it is to sell the product or otherwise. Again, trying to pick up on some like less conventional ones. The other test, which we've been thinking a lot about internally, is on the team side. So a common refrain recently, particularly in the last 2 years, maybe it's changing with the current macro environment, but common refrain has been it's really hard to attract talent. And that's true. And a lot of our portfolio companies are struggling to hire, and it's certainly a tight labor market. But interestingly, if you speak to the best founders and the best businesses, they have no issues on attracting talent. So we actually have recently started to ask businesses a lot of questions around talent acquisitions and talent pipeline as a means and a gauge to assess the quality of the overall business. At the end of the day, it just amplifies our diligence process. Because if you're an employee thinking about joining an early stage startup, you've probably done your own diligence around the product, the other people on the team. So we see that as a very strong signal that if this team or this business is a hub for the best talent in the market, they find it really easy to attract, great people to work there. There's probably a signal in that pattern that suggests that the business is doing something right. And as much analysis as we could do, we like to sort of, look at that as a key indicator. And those would be two sort of less standard ones, I think, compared to what other funds look at. The other thing that, clearly is important to us, which again, all funds focus on, but I suppose to a different degree, is just the efficiency of the business overall, particularly on the spend profile. Our portfolio tends to be far more conservative in terms of burn profile. Not a lot of our companies are doing the very high burn, very high growth playbook. All of their spend is, efficient and often profitable, to be honest, certainly on a unit economics basis. And I suppose we've been over-indexing on that just historically the whole way through. Like, one of the best investments I've made is into a business called Vendor Panel, led by a founder called James out of Melbourne. When we invested in that business, they were growing, we invested about 5 years ago, they were growing at, I think it was about 18% year on year, which is unheard of as a venture investor. But there was an insight around the quality of the revenue stream, the efficiency of their spend, that with a capital injection, we believe they could accelerate, and that's sort of exactly how it played out. So we spend a lot of time over-indexing on like how much does it cost to acquire a customer, how long do they stick around, what is the quality of that customer relationship, which again is an indicator of an ability to upsell them over time, maintain the revenues and grow them as you scale. So a lot of standard metrics, but I think if founders can start to position themselves as a hub for talent, building a real business with underlying good economics, and one that customers rely on and are willing to purchase in a relatively easy way. Those are some of the main signals, at least for us at EVP.
Yeah, I want to come back to the efficiency piece, but just going back to the win rate that you mentioned earlier, are you able to share what a good or a great win rate looks like for you?
Yes.
Or just benchmarks for companies?
For sure. So these are rough numbers. If you're two founders with a team of 10 to 15, and it's basically the founders trying to win customers, I think you should be winning at more than 50% of every conversation you have. And when I say every conversation, like, a qualified customer, a qualified lead comes in the door. If it's the founder that's the business leader making the sale, they should be converting at an extremely high rate. And again, we've seen 60, 70% previously, and that's a great signal. On the flip side, if you're a later stage company with a 20-person go-to-market team and there's conversations at all levels, clearly your conversion rate, trends towards 20 to 15% over time. So it really is a stage thing. It's also a business model thing, whether you're sales assisted, whether you're self-serve, whether it's much more involved. But I think typically where it's a sales-led motion at the early stages, you'd want to be getting cut through in a lot of conversations where it's founder-led, on the basis that as you start to scale the team, it's going to simply be harder for them to close those deals and close those accounts over time.
Great. And going back to the efficiency piece as well, as you mentioned, the last couple of years have been, a great time from both the startup and a venture capital perspective. There's definitely been no better time to kind of fundraise, and there's never been more capital in the market. But, definitely things have changed in the last 6 months or so. And, founders are sort of reassessing how they sort of approach the build and their kind of burn rate. What advice are you giving to your portfolio founders at the moment, or kind of what advice would you have for early stage SaaS businesses right now in the way that they sort of strategically think about building the company, or that they're thinking about their burn rate?
Yeah, for sure. So you're right. There's been a complete change in sentiment and reality in the last 6 months. And it's been interesting to see how quickly it shifted, obviously led by the sort of US tech equities sell-off. I would make the comment, we are a little bit insulated from the impacts for a few reasons, the stage, but even our late stage businesses. I mean, the main trend that's been playing out is one of multiple contraction. And as you say, in the last few years of free money and easy capital to access, revenue multiples simply got out of hand, and 30, 40 times revenue was commonplace. I mean, I was on a panel with a VC fund about a year ago where they were saying entry price doesn't matter, and it's just about access and getting your foot in the door. And multiples have contracted so quickly and so enormously. The average multiple now in the sort of US traded listed space is, I think it's about 6.5 times ARR roughly. And if your multiple has come off to that degree in such a short period of time, just to get back to the last round price, your business probably has to 3 or 4x or more in a very short period of time. And there's not a lot of businesses that are 4xing over an 18-month horizon, particularly at scale, which means founders that have raised money at exorbitant pricing are stuck because the equity market is largely off limits for them. It's very difficult for a lot of them to entertain down rounds. So it necessitates that they look at the OPEX base rather than sort of the equity market to fund it. And, there is venture debt and some other options. But that's been the main trend that's happening in the last, I think, very short term, 3 to 6 months. And why I say EVP is a bit insulated is not just by virtue of the stage and the business model, but also our average entry price in the last fund, which was allocated in that 2-year exuberance period, I suppose. The average entry price was 8.4 times annual recurring revenue, which is pretty much where the market's trading today, and we still believe is very fair pricing. So it means that a lot of the companies we work with don't have to worry about that multiple contraction phenomenon. It means they can still raise equity if they need to at relatively fair pricing. And the businesses in that fund, I mean, we just did the numbers to June year end. Average growth rate in that fund is about 153% per annum. So they're still very strong, high performing, extremely high quality startups, but they simply have been priced in a way which doesn't have that pressure of the broader market. So the advice to our companies at the moment is focus on solid business fundamentals. Don't rely on equity fundraising, which is certainly going to be harder to attract in the next 12 months. And the other thing is, because of the B2B software model, the levers to flex up and down your discretionary spend is relatively easy and extend runway. So we're working with a lot of founders over the last couple of quarters to extend runway. But for our businesses, it doesn't necessarily mean raising more capital, and it doesn't mean changing the OPEX base either. It just means sort of change the discretionary spend and the pace of your growth that you think is most appropriate. I think more broadly, the advice, there's been a lot written, and it's not like I'm the most experienced person in this area, but certainly you want to act quickly and decisively. We do have a small number of companies that were planning equity raises in Q3 of this year, and we think the market's not going to dissipate. There's an absolute wall of dry powder that's waiting to be allocated. But in our view, you can't rely on a business plan that sees an equity fundraise in a 3 to 6 month period. So there are some companies in the portfolio that we're working with closely to sort of change the plan, which unfortunately might mean headcount. You need to do that quickly, decisively, to give yourself the flexibility to manage through. And I think for most of our founders and most of our businesses, we're just really fortunate that they can sort of ride these types of things out and maybe are less reliant on capital raising as some other business models.
For companies that are potentially raising for the first time or aren't in a position to be able to see out the next 12 months without an equity round, do you have any advice on how they should be approaching the valuation discussions?
Okay, very tricky. So, again, valuations have gone back, to be honest, to where they were 2016, 2017. We happen to think they're more sensible and probably fairer value, but there is still a lag. And that, in truth, in the founder community as we stand here today, in the middle of 2022, there is still a bit of a lag effect. And there's a lot of founders that maybe aren't across exactly what's happening in the macro or the equity environment. I think expectations on pricing and valuations just have to shift, and they probably haven't shifted for all businesses. If you're an early stage business that hasn't raised capital previously, it's still possible to raise. We're still allocating. We have, I think, 3 or 4 term sheets in the market at the moment, and there's still an active VC community. But certainly the quality marker or threshold or hurdle, I suppose, to overcome has increased. People are more focused on pricing, valuation, efficiency measures, and yet it's more difficult to raise. So I think if there's a way to build your business that doesn't rely on fundraising, which is fundamentally the best way to build a business, if there's a way to do that, I think that's first prize. If there's no way to do that, then it's going to take longer to raise the money. Potentially your valuation expectations need to change, and you potentially need to be willing to ultimately part with more of the business and suffer more dilution to go on that type of funding journey. The other thing we're seeing is, particularly for later stage VCs, if you've allocated your fund at an average of 30 or 40 times revenue over the last 2 years, and if those businesses are really struggling to attract capital, even at the price of the last rounds, then as the fund manager, what you start to do is you start to reserve your dry powder to support the existing portfolio rather than to allocate to new companies in the market. And we're seeing a lot of that behavior with some of our peers, where there's internal bridging rounds across the board, and they're looking to support businesses with an extra 12 to 18 months of runway in a very quick financing rounds, often at depressed pricing or at the price of the last round, despite maybe the business performing. So again, I'd say we're still allocating, and we're probably not in that position just individually at EVP, but more broadly in the VC community. There's certainly less action in new investments, a propensity for people to reserve to support existing portfolio companies, which again makes it a little bit trickier for founders looking to raise first-time capital. So, I think it's just give yourself enough time. It's going to take longer. There'll be more meetings. You might have to go through the motions of describing the opportunity in greater detail than you would have a year ago. And I suppose prize A and first prize is if there's a way to start the business, build the model without relying on a capital raise, that's first prize, I think.
Yeah. I was reading your profile in Letter of Intent by Cal Jamshedi. Huge shout out to Cal and the work that he's doing with LOI. And one of the things that kind of really stuck out to me, well, there were 2 things. One was how you have a daily routine that you have on tracking the metrics for the founders every day in your portfolio. But the second one was, I think you briefly mentioned just the imposter syndrome that kind of came from your career and being really, really early. And I think it's such an important topic to kind of cover both from a founder and from an investor perspective as well, in terms of, just a lot of my private conversations with founders have a lot of that kind of tone. It can feel very isolating because it's a difficult topic to kind of talk about, and there isn't kind of more open conversation about it. But yeah, just be kind of curious about, how you've dealt with that in your own journey, and I guess what are things that you do to either mitigate that or kind of work through that for yourself?
For sure. It's an important topic, and imposter syndrome is certainly real for me personally, definitely. I've been the youngest person in a lot of rooms historically. And the way I've dealt with it personally is, again, I mentioned this phrase before, but I've always thought you sort of earn the right to participate, to discuss, to give advice. And you can earn that right in many different ways. And you can have decades of experience. You could be an operator in a startup that gives you an advantage to help new founders. The way that I think I've earned the right is just through preparation and commitment. And sort of my personal mantra, to be honest, is just to be 5 minutes early for everything. And that's not a time thing, obviously. It's a commitment, it's a preparation thing. So, my personal KPI, I suppose, is that for all board meetings or, across all meetings across my day-to-day, I just want to be the most prepared person in every room that I go to. And often that's the advantage I have, where you can be in rooms full of people with, much more experience and much more right to participate in the conversation than I have. But because I've done 5 times the effort in preparation and commitment, I've checked in with the founders in between meetings all the time. I'm in the dashboards, the accounting tools of the team, looking at it every night, writing it down, just like religiously, like consistent. You're better calibrated, you're better prepared. And I found that that's been sort of the secret sauce, at least personally, to overcome some of the imposter syndrome, where sometimes you can be in a position where you're actually ahead of the conversation just because of the preparation, despite being very young and having less experience. It's difficult to deal with. It took a long time. I still certainly have imposter syndrome all the time on a day-to-day basis, but at least that's the way I've tried to address it and tried to handle it. And it's definitely a mantra, I live by. But yeah, that's probably the comment there.
Yeah, and just to kind of pick up on something you just mentioned in terms of building that commitment and earning that right, one of the things that really stuck through and was a consistent theme through everyone that I spoke to as part of the research process was you always seem to be one of the first people that people reach out to for help or just kind of get general advice. I guess that's a topic that kind of comes up a lot in terms of, the founder-investor relationship and how to really build that bridge and build that relationship. Again, from conversations with founders, it can be really hard to kind of understand where that line is in terms of, what are things that I can go to my investor with. So from your perspective, like I'd love to understand, what are things that I guess founders should be coming to you with that may not be as obvious for them?
Cool. So I don't think I've mentioned it. The EVP mandate is to take board seats with all investments and to try to be a very involved, active investor. We actually have 2, sometimes 3 people that run point on each investment, post-investment. So it's not a passive mandate. So this is important to us. The KPI we run by internally is to try to be, and it's a bit trite, but it works, is to try to be the first phone call from founders. And that's for good things, for bad things, for unusual things, for everything. I speak to my founders all day, every day. That's part of the job. But you want to be in the information flow. You want to have built a strong relationship such that they feel comfortable coming to you for all kinds of stuff. Recently, I've had founders talk to me about personal finance issues, tax issues, relationship issues in their marriage. We get invited to all of our founders' weddings. And in truth, to be honest, at least how we operate, the founder-investor relationship goes well beyond a boardroom, well beyond metrics, well beyond probably a typical business relationship. And that's really, really important for us. Like we find at the end of the day, as a VC investor, you want to have influence, you want to have a seat at the table in a positive way. You want to be able to help the journey. And the way to do that is to build excellent personal relationships and be there and the most committed person for a long period of time. It's actually our pitch to founders. So, we're not the biggest fund, we don't have the most capital, and we don't have the best expertise to help you build your business. But we guarantee that we will be the most committed, we'll be there for a long period of time. Shippit, Will, you mentioned earlier, is a good example. Les and I from my team have been going to board meetings there for over 6 years. I think we're the only people left standing, and it's been a total change in the board, probably 4 times over that journey. And that's our pitch to founders, is that we will always turn up, we'll get around a table, there'll be interesting times that are good and bad, and we'll figure it out together. And we're good people. We think we have relevant experience, particularly by virtue of the specialization. But the promise is just that we'll be fair, we'll have integrity, we'll be good to deal with, and we'll figure it out together. And that's just so important to how we operate. We have countless examples, to be honest, where we've looked after the human side of a founder, potentially well ahead of the commercial interests as a fund manager. But every time we've done that, it's ultimately paid back many times over the journey, also from a financial commercial outcome. And personal relations is just everything in our world. And we spend a lot of time trying to invest in that partnership approach to investing. So, to answer the question directly, we'd encourage founders to come to us with all kinds of weird and wonderful stuff, sometimes well outside of the business environment. And, that's sort of how we look to operate.
Fantastic. On that note, Justin, thank you so much for coming on the podcast and for sharing your experience and insights. For anyone that wants to find out more, say hello, get in touch, what's the best way for them to do that?
We're totally available, justin@evp.com.au. Please reach out anytime to anyone on the team. And look forward to saying good day to anyone listening to the pod.
Perfect. I will make sure that's included in the show note. Once again, Justin, thanks so much for coming on the show.
Thanks for having me, Rohit. It's been great.
Thanks for listening to episode 167 of the Startup Playbook podcast. As always, full show notes from this interview will be available at startupplaybook.substack.com. I'll be back next week with another episode, but in the meantime, if you enjoyed this interview, please don't forget to like, share, and subscribe. As always, thank you for tuning in, and I'll see you next week.